featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities. If you have any questions, please give us a call on 1300 30 34 35 and the email is yourmoney@skynews.com.au. Now, joining me tonight is Vincent Hua. Vincent is the Chief Investment Officer for Mason Stevens, and we have David Stewart, who is the two chiefs in one plot. Chief Investment Strategist for Mercer Funds. Welcome, gentlemen. How are you?
And you're lucky.
Fine, thanks.
I'm very lucky to have two chiefs and one Indian. Tell me about the Mercer business. Is clearly a massive business, and it has a range of different people come in and talk to us about their different changing personality, if you like, attracting different customers. You're also part of the dynamic asset allocation, and so can we just talk a little bit about your role for Mercer and what a chief strategist is looking at and the sort of customers that you'd be appealing to?
Okay, well, the area of Mercer I work in is clearly the investment area. We provide both investment consulting advice to major superannuation funds, major insurance companies and charities. We also run some money ourselves at what we call implemented funds, and I provide basically investment strategy advice to both of those arms, so both to our consulting clients and also the internal funds.
And talk me through dynamic asset allocation. Is that around the idea that the set and forget, which Vincent would have hated, the idea that you'd set and forget, that's a bygone era and people shouldn't be doing that, and that's what dynamic asset allocation is?
Yeah, I think set and forget is dead. Really, it's
just like 70-30
properly medium-term asset allocation. So given our client base, we're not trying to move money on a day-to-day basis because we need to get the data out there. So we're adopting a medium-term investment horizon, and we're advising clients how to move their portfolios to capture opportunities which arise in markets.
And it's been successful at the moment. It's, in terms of that reaction, people want to have that sort of advice. I take it it's a lot of confusion.
Oh, it's very much a growing area, and we've built quite a substantial client base in the large super funds, and as I say, we also have a large internal unit which is utilising that advice. So,
Vincent, I've known you for an awfully long time. You were in reverse order. So you're at Westpac for 7 years. You go to Shinsei Bank in Tokyo, and you're chief of trading and markets for that. You then come back to CBA, head of trading globally for CBA, head of trading for Lehman's.
Yep.
How's Mason Stevens? How's that all going?
Good. Look, I must admit, it's the best job I have so far.
Really?
Yes. The ability to see real money, money that you have to look into people's eyes because it's own money rather than agency money.
Yeah.
Somebody else give you the money. And
there is an element of that, isn't there? Like in these big organisations, it's very hard for them to be in touch. When you're investing tens of billions of dollars,
absolutely,
or you're borrowing in the form of CBA, pearls. If you're part of those, the hybrid issuance, you're taking billions of dollars. It's very hard to get in touch with that mums and dads or that institutional investor from Mercer saying, "I want to lend CBA a lot of money." It's very hard for CBA to say, "How are you?" Getting that connection. When I think of Masons, it's a platform for the financial planners. It's a private private wealth business, or it's servicing the family office type stuff, and then you've got the credit fund. Am I missed any part of Masons in that?
Well, Mason Stevens is basically set up by my long-time partner,
yep.
and a few of us. Pat Henley,
yep.
obviously was the CFO of Westpac,
yep.
when I was there. I know him for a long time. We set up basically as an enabler. So we want to provide infrastructure, for our client to be able to match their return,
yep. So
to their risk,
yep.
profile. Right? So the way we do that is obviously apart from technology, which is very important, we also enable them to transact and execute any asset class, whether it's bond, equity, or whether it's in US, in Europe, or in Australia. We really don't.
You don't care.
We don't really
You're
care.
agnostic to the.
Absolutely. So for us, it's dependent on who you are. Right? Our philosophy is to make sure that you manage your return profile that's consistent with your risk profile.
And David, how do you find that with, you must have the same thing. You must have different industry funds having different requirements where people are entering into it, and I'm just using industry funds as an example. Somebody starts work in the building trade, becomes a building, industry fund member, but people leaving would be different. So do the industry funds come to you and say, here are my demographics, what are you recommending for those people? Is that what they do?
Yeah, we do increasingly look at the split of the fund, how many young people versus old people. Even gender may also have a difference in terms of the investment strategy of the fund. The latest trend in the mainstream superannuation market is to adopt some kind of life cycle fund whereby people actually gradually move their investments into lower risk assets as they approach retirement age, and that's an innovation which is really coming in at the moment, and Mercer's certainly one of the consultants which we've been leading that move.
And that'd be consistent with your sort of thoughts in terms of the longevity issue around people who look to retire. They would come into you and say, I've got X amount of money, I need to live on 10%, and you'd say, well, that's crazy, you need to work longer. Or do they often come to you and think about the longevity piece?
Oh, absolutely. I think, ultimately, everybody want a high return.
Yeah.
That, obviously, if you can get a high return.
For sure.
Okay, so that's the known bit. The unknown bit is, how much risk am I taking?
Yeah.
So what
sort of risk are you taking when you say, I want to buy this product, whatever it might be, that they often don't understand that risk, do they?
That's exactly it. So we offer two solutions. For the people who understand the risk, they can make their own decision by having us, as an infrastructure.
Yeah.
For the people who are not very comfortable with managing the risk, then we run their money, but individually.
Right.
So
okay.
your portfolio is yours.
Yeah.
And different from anybody else.
Right. It must get hard to manage that. As you grow, you've got a lot of people coming in. Does that just mean you start becoming the employment of the financial sector? Because, there's lots of guys who want jobs at the moment. I don't know if you're all watching, guys. But is that something that you are aware of, that as you get that personalised piece, you're going to have to expand that personalised piece?
Well, look, ultimately, I think, the scale issue will become an issue at some stage, like any other business. But for us, we're still a long way to go. Yeah,
right. I wanted to talk to you both about Governor Stevens and the interpretation of Governor Stevens telling a joke. For the viewers at home, you may not be aware, but the currency again got sold off on the basis that Governor Stevens said in, I think, Brisbane, that they thought long and hard about the interest rate settings. And he meant that's Governor Stevens' form of a joke, which I suppose for a Fed governor, that's what you want. Very dull. But the market reacted. It sold the currency. It said, hang on, there's something more to it. What's your interpretation of the reaction of the market?
Well, I think clearly the markets, particularly the bond and currency markets, are very skittish at the moment.
Yep.
Since Ben Bernanke talked about the gradual withdrawal of quantitative easing, people are looking at, well, how quickly is that going to happen? And the Australian currency has clearly been one of the targets. It's been sold down over this period. So anything which hints that there may be a change in interest rate policy or whatever is having a very big impact relative to normal. So markets are just very jittery, very high volatility, and that's the problem.
What did you think?
Well, why don't I answer your question by having a joke first?
Oh, well, that's good. I love Vincent's jokes. Let's have these jokes.
So you recall the last time the Fed had a meeting and Bernanke fund up to the press.
Yep.
Right, he had a prepared set of speech
that
he gave.
Bernanke was prepared.
In fact, the market reacted extremely well of that set. Obviously, they didn't say, there will be time in the future where they're going to do something, but they're not doing anything yet.
That's right. So they said in the future they'll taper.
Yeah, but, however, after he finished his main speech, he made a few side comments. And that's where it drove the market down. Okay?
Yeah.
So I think Grant Stevens,
he's like Bernanke.
Exactly.
He makes a comment.
Exactly. But I think the Aussie, I agree with David. I think the Aussie need a reason to be sold up, to be sold anyway, because the market, as you know, Aussie have been really weak in the last 4 or 5 weeks. And it was just another excuse. I think,
when you're reading the paper, everyone was saying Soros is selling. I mean, as if George Soros is going to say, I'm getting short the Aussie. I mean, it just doesn't happen. But journalists were writing. I was being asked questions. How did you work that out? You saw him in the at a cafe, I'm selling the Aussie. It's just very hard to imagine. But you were right. The Aussie was looking for a reason to get sold off. David, can we talk about the panic that you were telling me about, the panic metrics?
Yeah, I mean, we monitor things called risk appetite indices, which you can look at for bonds or equities or for markets as a whole, and these really measure what's the sentiment in markets as displayed by their price moves. And when sentiment gets extreme, it moves into either euphoria, when everything's looking rosy, or panic, when everything's looking bad. And for the first time since the GFC, fixed interest rate markets moved into panic a couple of weeks ago. And that's a suggestion that probably things are getting oversold, actually, but it is a symptom of today's markets that people are very, very nervous.
I mean, that's what we see in terms of at FIIG. We see a lot of clients now coming looking to buy the fixed income because they're at levels that they hadn't seen before. They are looking at Stockland, or they're looking at different bonds at 4.5%, 5%, these sort of rallies with everything in cash is going to zero, and now they're at 5.5% and 5.75% and 6%, and people are saying, wow, 6%, I haven't been able to get that out of my equity performance. So they're selling out of the banks at $73 in CBA, and they're buying they're buying fixed income in senior debt at 6%, and that seems to be driving them. So your panic point is probably quite relevant. I'm just going to I think we're going to go to a short break. Please give us a call on 1300 30 34 35 for any questions you have on investing, or the email yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities, and joining me on the panel tonight is Vincent Hua, the Chief Investment Officer for Mason Stevens, and David Stewart, the Chief Investment Strategist for Mercer Funds. We will take our first email for the night. The email is from Wendy from Greenpoint, and she writes, I'm a few years from retirement, and I'm in an industry fund. The fund is a growth fund. There is a capital stable fund that I can switch to. My question is, what is a capital stable and what is a growth fund, and how do I find out? Wendy sent this email in just through the week, and so I reached out to Wendy and had a chat to her. So to give you a sense of it, and I'm going to point to you, David, about this one, she had $500,000. She is about a year or two away from retirement. I guess the idea was that when I talked to her, my key theme had been, you need to understand what's in the portfolios, and so I wanted to get your thoughts on how to go about doing that, because you'd obviously
you obviously need to know where you are at the moment. And broadly, growth funds typically have about 70% in equities and other growth-like assets, and about 30% in bonds, whereas capital stable is probably almost the reverse of that. So that's normal, but really she should look at the website for her own industry fund. They always display the asset allocations for their different options, and so she'll get more detail from that.
Yeah, and it was an energy, I forgot to mention, it was an energy industry super fund. So I think it's not like it's a small fund, they're big funds, so they can go and get all the information you like. It's all about that question of the education, isn't it? Working out what growth means, what equities, and if you're uncomfortable, move out, switch out and go to other organisations that you could recommend. Mate, volatility. What's your thoughts about, you've been around the block a lot, it's because you're old. What do you think about volatility, Vinny, about how is that becoming a driver for investment decisions?
I think last time I checked, you're a bit older than me, mate.
Only a very bit.
Okay. Look, interesting now, I would say this. Volatility should not be part of investment decision. Yep. Right? It should be volatility is perfect for trader.
Yep.
But then you want to get in and out quickly. But as an investor, you should look beyond that. Okay,
yep.
And look at assets that are fundamentally sound, and it suit your investment horizon and profile. Mm-hmm. Now, in the meantime, whether it move up or down tomorrow, hardly make any difference. The only time it make a difference is you want to get out.
Yeah.
So, from my perspective, and fair to say that I think in the last couple of weeks, I have not seen this sort of volatility.
It's been crazy
in the market for a long, long time. In fact, last time it was at this sort of level was around 2010 or something.
Yeah.
And admittedly, that was straight after a crisis. But you look at, for example, our equity, which I'm not talking individual stock, I'm talking the indices have been moving around 1.5 to 2% a day for the last few days.
Yeah.
I mean, surely anybody make the investment decision based on those movements is crazy, in my view. All right. And the other thing that I also want to, you mentioned Telstra before. Okay. I mean, a week and a half ago, Telstra was trading at 450 and nobody wanted. And today it was at
476 or something.
Exactly right, and it was actually 480 2 days ago.
Yeah.
So surely, what had changed in Telstra in that 3-4 days? Nothing.
I'm with you.
So that's the problem, right? So it should not be part of your investment.
It shouldn't be. David, your thoughts? Do you agree with
I
Vincent?
broadly agree with Vincent. I mean, volatility is an opportunity for traders. For long-term investors, you really should be trying to look through it. The advantage of being a long-term investor is that you can take on more risk because you're not worried about short-term price moves. If you start looking at short-term price moves and start panicking at the wrong time, to be honest, you shouldn't be in those sorts of assets.
Which comes back to my segue a little bit. The fastest growing sector of the investment community is the self-managed super fund. That's the reality. The industry super funds are trying to win them back and everyone's trying to service them. All the banks, that's their private wealth mantra. Just go and get those self-managed super funds. They're the people that are suffering the most from the volatility because they're not experienced. They work as for 50 years as an electrician, a doctor, a plumber, whatever, and all of a sudden you're now a fund manager. And there's a disconnect. They do it because they feel they want that control, and then that control is quite scary to some extent. If we look 3 years down the track, is the same sort of growth in self-managed super funds? Or do you think they're going to come back and say, Vincent, take my money, Mercer, David, take my money? How do you see it? And don't just smile and think, beauty, I'm going to get the money back. How do you see it playing out? Because it's the $64 question in my mind.
Yeah, I think it probably is a longer term trend actually for more self-managed super, but as you say, I think the industry funds are trying to accommodate people's desire to have more choice by, for example, allowing them to buy shares as part of their industry fund exposure. So I think there'll be quite a lot of innovation to try and retain some of the self-managed super funds in a more hybrid sort of setting. So I think that will be the main development.
What do you think?
Look, I think super fund, self-managed super fund will continue to grow. That's part of life because people have more money and obviously they can do a lot of thing that they're not able to do when they have less money at the poor growth. At the end of the day, it's like any other thing. Investing in a fund, one of the issue that people need increasingly coming to terms with is there's only one outcome of a fund, a return and a risk outcome. And so even though we have thousands of investors in it, therefore it must be an average profile.
Oh, that's right.
So if you have a lot of money, why do you think that you should be part of an average?
Yeah.
You should be unique.
I couldn't agree more. I hate the index huggers. I hate the finding everyone else that's doing the same. I want to be part of the middle. It's just crazy. You don't want to be doing that. We are going to go to a break in a couple of minutes, but the first thing I want to do is show you a chart that I put together. This is the idea that to the volatility question, and David and I spoke about this chart at length. It's not simply to say that I'm recommending this strategy in respect to these specific stocks, but we have here the Duet company, and we have in the green line we have one of the assets they own, which is the Dampier-Bunbury natural gas pipeline. It's a fixed income bond that matures in 2018. And all I was trying to show with this chart was the idea that if you were uncomfortable, if you were a Challenger type person, those ads for Challenger where they look into the distance and they think, oh my God, it's a disaster. If that was what you were worried about, one of the reasonable strategies would be to presume that that bond trades at about 6% and that stock has some volatility in it. Why don't you buy a little bit of both? And I think the theme has always been at FIIG and organisations that are in fixed income, you don't only ever be in fixed income. That's crazy. But you don't only ever be in equity. You've got to be in both. It's just a question of look at the effect if you were in both for that. I think it would just make you sleep better. I
can't agree more.
You couldn't agree. Thank you. I love it when you agree with me. We're going to leave it there, but before we go, we're going to have to crank up our speed clock for our Speaker's Corner. And the first cab off the rank is the young chief, David Stewart, and your time will be starting now.
Okay, I thought I'd use my time to pass on 3 lessons that I've learnt in my 30 years of following investment markets. Lesson number 1 is to diversify. You'll never get everything right, so don't put all your eggs in one basket. Lesson number 2 is there's no free lunch. If something offers you a high return, it probably contains high risk, so be careful. Lesson number 3, be contrarian. If everyone thinks something's a great idea, the chances are it isn't anymore.
Very well done. Welcome back to Your Money, Your Call. The panel is answering any of your questions. We have Vincent Hua from Mason Stevens and we have David Stewart from Mercer. We have on the line Richard from Sydney and he'd like to talk to us about tapering.
Thanks, Mark. Look, just on the tapering, I mean, they're printing $85 billion per month at the moment. Look, I read the Fin Review today in Perspective that they have off-balance sheet debt in the US government to the tune of around about $200 trillion. I mean, this is Neil Ferguson, professor from Harvard University. I mean, that equates to well over $300,000 per person in the US. I mean, is this real or not? Can the panel discuss that, please? Thank you.
So Richard, the line was breaking up a bit there. So what he wants to talk about is the tapering, the idea that their balance sheet's now at about 100 trillion. They've got 85 billion that they're buying a month. The idea of can they possibly, what is tapering? We were going to talk about this before. I think the question, Richard, is the idea that this is a new world order. And can they have an orderly taper? I think that's a relevant question. So, is there such a thing as an orderly tapering?
David, I believe something. I think I'm the minority in the market. I actually don't believe, there's any tapering anytime soon. The reason I say that is, look, at the end of the day, I mean, there are two major issues with the U.S. economy. The first is, even though after free QE and $85 billion a month and $100 trillion balance sheet, the fact are the American economy is still nowhere near in its heyday. Okay, yeah. So it is an issue that is so far away.
The tapering is just forever. It's QE forever.
Absolutely.
Yeah.
And then the other issue that when it comes to tapering is this. The fact are the US government have never been in this much of debt. One of the easiest way, being an ex-banker, I can tell you, to manage debt is to inflate yourself out. Right? The higher the inflation, the better. Right? And whether you believe printing money will eventually lead to inflation or not is still debatable, but that's at least one of the tools that central bank will be using aggressively because it is a very cheap way to manage your debt.
You smile, David. Yeah. What do you think of that? Is there such a thing as orderly tapering? B, are you concerned about the size of the balance sheet of the US government? And C, do you agree with Vincent that one of the tools will be promote inflation and therefore reduce the debt? So, and if you could talk a little bit about how that works. I can understand it. But
well, look, in terms of tapering, I think orderly tapering is possible, but it will be tricky, and we're likely to see a lot of market volatility while the tapering goes on. Where I may disagree, I'm not sure Vincent's time horizon. When he says it's a long way away, I think we're going to see it this year, but we may not see it as early as September, which some people are suggesting. In terms of the size of the Fed's balance sheet, yes, it's very large. Yes, this is an unprecedented level of balance sheet size, but we've been in unprecedented times with a global financial crisis. I think the Fed did the right thing to keep the economy going. I think it will gradually use every opportunity to pull that balance sheet down. But in terms of the inflationary impulse, the balance sheet hasn't caused a rise in inflation because there's been no credit growth with it. So there hasn't actually been any rise in broad money supply measures, and therefore this idea that it automatically leads to inflation I don't think is true. And finally, will the Fed or every central bank use inflation to get rid of the debt? I don't think so. I think they learnt those lessons in the 70s. Once you let the inflation genie out of the bag, it's very, very hard to pull back, and it's very costly. You pay a premium on your bond yields for a very long time. So I think there are some short-term risks that inflation could rise a little, but I think the idea that they're deliberately going to target 5% or higher inflation isn't likely.
Well, how do you see them, if it's $100 trillion and they look at it and say, look, hang on, we've got a little bit of debt here, we've got X amount of assets, and we can match our debt with our assets and work out how our assets are performing. How do you think they're going to get out of it? What's the idea of managing this debt? What do you think they'll do?
Well, what they'll do is, firstly they'll slow down the rate of purchases. That's the tapering side. Then they'll withdraw. They'll reduce the balance sheet either by letting things mature or by actually going out and selling them into the market.
But what's that? Wouldn't the balance sheet of the US, and I could be wrong here, but wouldn't the balance sheet be more they're buying the long end, they're buying the 30 years and they're selling the short end? So essentially, their problem is when it loses 1% in value, the US has lost that money. In a market-to-market basis, it's lost that money. So now it's going to hold, it won't just hold it for 30 years, will it? Or what do you think, how will they hold that?
Well, I think the very long stuff they potentially will sell back into the market at some point. In terms of the losses, they potentially will make gains on some of the other things they've bought earlier. Interest rates have actually come down probably since QE started. So it's very different between a central bank and an individual household or an individual commercial bank.
I get that.
I mean, when we talk about this as an unprecedented level of debt, it's also an unprecedented amount of wealth in the US economy, unprecedented productive capacity in the US economy, GDP's higher than it's ever been. Everything grows and the debt's grown as well, and it needs to come down, but I don't think it's the crisis everyone is talking about.
Certainly the congressional feds, the Republicans are saying this debt, this has become such a massive thing, doesn't it? The idea that you've got a debt ceiling that you used to ratchet up all the time, and now, you have to go into these filibusters. That's just politics. I understand that, and I get that that's crazy. But how do you interpret?
Matt, one thing that's also we got to let's stick with some common sense here and not worry about not worry about some a bit of theory in a minute. Is this? Every day, the money borrowing process is interesting for economists and talk about what is the right level. But ultimately, in a real economy, borrowing money means this: you consume more than you produce.
Yep.
Okay, and for that to happen indefinitely, somebody else had to consume a bit less, given that the output of the world is finite at any point in time.
Yep.
Okay. Now, traditionally, for the last couple of decades, the East has spent a lot less. Their saving rate has been.
So China has funded the US.
And the Japanese to a certain extent as well. So now, as those people age and as their economy improves, okay, they whether they want or not, they will need to consume a little bit more than they used to. Right? As a result, that some of us in the West have to consume a bit less.
You're on a roll, okay? Now, hang on, David. You're gonna have to come back and rebut this. But before you do that, we're going to have to go and leave it for a quick break. But before we do the break, we're going to have Vincent Wiley's on a roll. He will do Speaker's Corner. Speaker's Corner starting now. Tell us what's on your mind. You have your 30 seconds. We'll start now.
I think David offered you three piece of advice, and in fact one of those was what I was thinking to talk to you. And I think at the end of the day, as an investor, the only thing I'm worried about is the risk. The return is an outcome. The risk, you need to be able to make sure the right level of risk that you're taking, that you're comfortable with. Now, to do that as an investment, I would think that diversify is one thing, and the other thing that people increasingly, I think, should think about is to find protection, to buy protection directly.
We love protection. Welcome back to Your Money, Your Call. On the panel tonight we have Vincent Hua from Mason Stevens, who is the Chief Investment Officer for Mason Stevens, and we have David Stewart, who is the Chief Investment Strategist at Mercer. Before we went to the break, Vincent had his Speaker's Corner. What were your thoughts? You were going to rebut.
Yeah, look, all I'd say is I think the whole debt and inflation thing potentially, which the market's worried about for 5 years, and 5 years ago people said if you do QE, you're going to end up with rampant inflation, it will do nothing for growth. What have we got in the US at the moment? We've got improving growth. Inflation actually hit its 60-year low in the last report. So where is this inflation? But we're still worrying about it. I think what you've got to look at is where are we worrying too much and where does that give opportunities? Because there's various assets. Gold was a classic one, which have been pushed to ridiculous prices because of these fears. It's an opportunity for investors to put things into perspective.
You're not to talk about gold. Right.
I understand.
He loves gold, and he just cannot. If we're going to have a gold conversation, this will take us forever. Look, let's talk about. Well, let's keep on that theme about the worrying theme, because I agree with you. I think everyone is worried, and I think I did a presentation a few weeks ago, and I called it "Rise Above the Noise," because you can get so focused on all the bad news, you lose sight of, well, hang on, that's 6% and that's 8%, and to your point, Telstra, what did it do to improve its performance? But there are enough out there to say if you're a worrywart, you could find it. So Europe, the ECB put out its commentary yesterday saying we'll give you some forward estimates, and the forward estimates said we are worried, interest rates are going low, we have some real need for reform. I'm paraphrasing, but they didn't come out and say everything's fine. They didn't do that. That's I'm not paraphrasing that. You've got China doing the change in sort of the political change, the shadow banking, how to manage all that. You've got Japan. I've said on many times they sell more diapers for adults than they do for kids now. So they've got an aging population, and you've got this QE that's literally just started last week, metaphorically. What are you worried about? Is there anything on the horizon that you say, yep, this is the one I'm most concerned about?
Look, concern obviously implies risk, right? And obviously, for me, doesn't matter how much concern I have. But you pay me enough money, the worries seem to disappear. Right? That's my philosophy. Okay.
What in terms of return?
Yep. In terms of the return and risk, got to go hand in hand.
Yeah,
right? There's no point worrying about something, right? Because look, the only risk-free investment I'm aware of is put your money under your mattress, which is not going to work, and we all know, right?
Yeah.
So, as far as I'm concerned, right, in terms of investing, here's my philosophy. Whether we like or not, one of the things that I believe firmly is risk asset. And let's just use equity as a proxy, right?
Yep.
Because there are many other risk assets.
I love equity as a proxy.
Yeah, as a proxy for risk asset. The price of equity in the last few years, right, have driven up at least partially by the amount of QE or money printing that's in the system. Definitely, it's just a matter of degree.
Would you agree, David?
Oh, yeah,
the amount of, there's been that crowding out, hasn't it?
Correct.
You look around and you say, what am I going to buy? And everyone, I talk to US hedge funds who normally bought loans, and there's just nothing. The government is buying everything, so I'm going to have to buy, Brazilian debt.
And as a result of that, people, as you can see in the last couple of months, when even the talk of potential withdrawal of liquidity, in other words, tapering. Right, have created the market, created all this volatility in the market for that reason, because that is one of the input into asset prices. Now, we all know, at the end of the day, investing in a fundamentally sound company, right, credit is just one of many input into, right? And so, this notion that, well, look, if the credit's gone, my company worth a lot less. I'm not so sure how you reconcile the two. Never mind, go on to that. The other thing that I would also say, picking on the inflation theme that we were talking about before, is this. Inflation did not happen in the last 5 years because clearly there was a lot of excess capacity in the US. Labor, excess capacity. Housing, excess capacity. Now, God forbid, some of those hopefully have been used up. Okay. Now, I'm not predicting inflation will happen magically overnight as well, but I think that's one of the risks that if it ever happen, right, you've got to make sure you are
protected.
Exactly.
Protected
have some
inflation.
Exposure.
You're talking my language, Vincent. What are you worried about?
Well, whether you take the protection or not depends how much you have to pay for it. And what we've seen is that inflation hedges in particular have become incredibly expensive because so many people are worried about it. And that's my concern.
David, I think we will go to the next segment when we can tell you some very cheap inflation hedge.
There are, well, David, you're right, but it depends on who you're talking to. And if you're talking, as to your point, if we're talking buying billions of dollars of inflation hedge, completely, the tips and all the, absolutely, half a basis point. It's crazy.
Yeah.
But what are you? Stop saying this about this inflation. I'm a killer of inflation. talk to me about what are you worried about?
I'm worried. Of the three areas you mentioned, I think probably China's the biggest worry. And there's a couple of reasons for that. One, China is a lot more opaque than most of the other developed market economies, so we don't have as much information, we don't know what's going on. It itself is a very unusual economy to have grown so quickly from such a low base and being so very large. So that's one reason I worry about it. The other one is that China clearly has a very big impact on Australia, and so the recent data we've got out of China, which has been poor, the events in China with the spike in the interbank rates, which suggests that maybe all is not well with the financial system. These are serious concerns for Australia, because if China was to have a hard landing, and that's certainly not our prediction, but we accept that there are some risks, that's going to be very bad news for Australia.
And I think you made a really good point when we were talking earlier today about the idea that we have suffered from the headwinds that tapering and volatility created. So everyone sold Aussie, and you were making the point everyone was looking for an opportunity. But it was that combination of that with China created much more pressure, and I felt all of a sudden we've gone overnight into recession talk. And it's been very quickly from we are the icon of where everyone wants to be as an economy to hang on, you're about to head into recession. So how do you think we're going to have a recession, or what's your predictions for our economy going forward?
I
Medium term.
Forecast a recession. I think the risks of recession are very high over the next couple of years as we transition out of this mining investment boom into something else. And the question is, what else? Will the consumer pick up the slack? Will business investment, which has been very, very weak, non-mining business investment been very, very weak, will that pick up the slack? Now, we don't know if global growth continues to recover, and if China can keep its growth rate up at around 7.5%, the chances of Australia avoiding a recession are much better. But there's no doubt the risks are high at the moment, and that's one of the reasons we tend to prefer, we're advising our clients, put a reasonable amount of your money overseas, because we see some specific risks here in Australia which aren't shared in the US or in Europe.
We're going to go to a short break, and I'm going with good grace because you didn't say put it into gold. So we'll be straight back. Stay with us. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and we are here answering your emails and your calls. It's been quite a busy show, so we've got a few emails we might try and get through near the last section. If you have any questions on fixed income or equities, please feel free to give us a call on 1300 30 34 35 or email us yourmoney@skynews.com.au. What's the low-hanging fruit? What's the thing that you think, right, we've just talked about the concerns. What is the thing that you say, well, that looks pretty good?
Well, as I say, we tend to prefer equities to bonds, and we prefer people get their money overseas. So the US looks like it's strengthening growth, and we're quite comfortable with that market. Europe, if you want something that's a bit cheaper, we also think Europe is gradually going to drag itself out of the mire. So overseas equities will be our favoured section, and again, we think the Australian dollar potentially has further to come down in the medium term. So you'll get a kicker from that.
I'm not going to ask you what your low-hanging fruit is, because I'm going to ask you about your credit fund. Let's put up a chart. Vincent's been able to bring 3 charts for us today, and one is to show just the mantra of your concerns around the infrastructure inflation-linked bonds. So do you want to just talk us through that one?
Well, yes. I think we mentioned the word inflation many times tonight, but I want to talk about inflation in Australia in particular. So, I want to move away from the US and Europe and talk about Australia in particular. I think most of you watching the show will probably feel what I'm about to say very, very real. Think about this. A month ago, when you fill up your car, I bet you fill up with $1.40, and today is $1.60. That is real inflation, right? One of the results of that is because of the Aussie dollar. So we all want the Aussie dollar to be lower. As a result of the Aussie dollar lower, everything we buy is going to be more expensive in the month to come. We import everything.
Everything we import. I get all that.
I agree with that.
Well, hang on a second. Hang on. We'll bring an independent adjudicator in on that, and that was Chris Joy came up and said the same thing around the idea, and I have heard it from a lot of economists saying the idea of importing inflation through. We had price parity with the currency, and therefore we get better buying opportunities, and there is a consequence of the lower currency, everything, flat screens. There is. We can't deny that that's relevant. And
I'm not saying it's irrelevant, but it's not as big as people think it is.
But Benny's talking about the idea that our inflation is between 2 to 3. The RBA says it's 2 to 3. We settle at 2.5. That compared to the rest of the world is massive. The rest of the world's at 0. So for the viewers at home, they're more thinking about my insurance has gone up, my
electricity have gone up,
everything. I mean, we get that all the time now. At FIIG, we get a lot of that because we do a lot of the inflation linkers around the idea that it's a perfect protection against inflation if the cost is right. And I understand that you're saying there might be senior bonds, Sydney Airport, it's BBB minus or BBB plus. I get all that. I'm not advocating only one bond. I'm advocating the idea that look at inflation at 2.5 as a real cost of your investments and work out what your return is relative to that 2.5. When you hear the rest of the world, when you hear inflation's dead, it's not dead here. It is not dead in Australia.
No, but nor is it a major problem at 2.5. It's right in the middle of the Reserve Bank's target range. It's going to come down because the carbon pricing scheme numbers are going to come out of it. That's estimated to take about 0.6, 0.7 off the inflation rate. That will be offset by the fall in the dollar. I do accept the petrol price will have an impact, but these things are not, they don't suddenly shoot up to 4 or 5%. Very weak economy, retail sales very flat. What I disagree is everything we import, an awful lot of it, the retailers won't be able to pass on the margin, so they're going to take it on margin rather than push prices
up.
But
you have no data that's going to. That's presumption.
Well, no, it's not presumption. There is data actually. I mean, the RBA themselves said that every model they have of inflation caused by an exchange rate, they've overestimated the inflationary impact of the fall in the exchange rate.
In fact, it makes a very good point.
It does.
Hang on,
my turn. The RBA often gets it wrong on lots of things, so I get it. I get it.
Inflation would be higher.
I'm not disagreeing. I'm saying that if it sits in the band of 2 to 3, and you get an inflation hedge protection at 4 above that, that's something you need to consider. So it's 4.5 now for Sydney airports. It's there's a whole range of these inflation that are infrastructure products. You say, well, that's a reasonable investment in itself, as an underlying credit. So Australian universities at 3.5 plus.
I'm not disagreeing with you there. Inflation-linked securities may be a useful part of everyone's portfolio, but not because we suddenly think inflation is going to take off. It's a long-term risk, and it's a risk that you need to have some guarding against. Equities protect you against inflation as well, by the way.
By the way, I want to pick up one point that David made. Okay. If David believed that the imported inflation will be somehow absorbed by the retailer or whatever, then
I'm going to get Michael Harvey from Harvey Norman on. He's the main one.
Well, I mean, for those who own all those retailers, JB Hi-Fi, Myer, DJ, even Coles and Woolly, have to, think about it. That's not against inflation then, those stocks, because they are going to absorb a lot of this cost. So I don't know. So
I'm short in my West Office. Yeah. We have Raji from Queensland calling. Hello, Raji. How can we help you?
Yeah, I was just wondering if you can tell me a bit about the Schroeder fixed income. Are you familiar with that manager?
This line keeps breaking, Raji, so I think you've said the Schroeder's fixed income?
Yes, that's correct, yes.
Yeah, great. Are you familiar with the Schroeder's fixed income fund?
I don't know the individual product, no.
So Schroeder's offer an array of different. They're like Aberdeen. They offer different investment products. We don't talk specifically about one particular fund being better than the other and the like. I mean, that gets into some ugly phone calls. But essentially, when we deal with Schroders, we do deal with Schroders. I always find that they're really professional, they're really sort of on their game, they're really conscientious. I don't look at the experience of dealing with Schroders and say, they're a little bit, I'm scared of those guys, they're a little flying too close to wind. A lot of these fund managers are much more conservative than anyone else in the room. They're just by their nature very conservative organisations. But in terms of can we recommend them as a fund, I wouldn't go so far as that, but only because that's not the job that I do. It's just I don't have that. I don't do that work. I do other sorts of work.
But the only thing I'll add to that is, even if it's the best fund, I mean, you've got to assess your own circumstance, though, whether those funds are appropriate for you. I think that's more important.
Do you go buy the linker fund in Schroders, or do you buy the fix, and all of a sudden rates go up and fix looks really bad, but they're really good guys and they've tried their best. So, the one lesson is that you only lose sleep over your money. No one really loses sleep over your money, not in the same way. Unless they've done something really bad, they go to jail. How the fund? So let's keep on. I think we've got a chart that you might have brought in, chart number 2, that'll talk about the RBA's performance. RBA CPI versus the cash rate.
Can you actually see on the screen?
That's the one there on the right.
Well, that
it's hard to see, but we'll bear with it.
That chart is directly from Bloomberg, and as you can see, whether you like or not, the inflation rate is on the white line, and the rest, the other line is the RBA cash rate. And you can see, over the year, the two have been followed very closely to each other. But in recent months or year, it actually starts diverging. So the underlying inflation in this country are actually gradually picking up, even with the Aussie at a very strong level. That's where I said before, it was my worry, that the trend might be, too early to call a trend, but that's exactly what I would think that and especially in a situation where a lot of investors are very, very, very underweight inflation protection. Okay, especially if we can get opportunity to buy inflation protection at a very, very cheap level. And the cheapest time you buy it is when people think it does not exist.
Yeah, well, that's probably true. It's like anything, isn't it? But you're right. You're 100% right in terms of the big organisations. You looked at some of the government inflation, and it's 25 basis points, or it's. We're
crazy.
Not
talking about those, though.
You don't go near that, and if you need to have the liquidity to do that, then you need to find other tools. I do understand when I talk to the big pension funds, they say my greatest concern is longevity and inflation, and I've got a teacher's pension fund. All these people are living forever. What am I going to do? And I need to get, I talked to a fund that was getting a 10% return. It was a multiple of $1 billion, and they said, and we are going backwards at a rapid rate of knots. Inflation, and this was a few years back, but inflation was getting up, and people were living longer. And they said, we're just running out of money. They started to go to the government and saying, we've got real problems here. We'll be right back with our final segment, so please stay with us, and we'll talk to you soon. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and we have another email, so we'll take this email. And this is from Warwick from Wallara, and he writes, I have traditionally bought equities, but I think I should now be buying bonds. How do I start? I suppose, what's your reaction to Warwick? Other than, don't say give
Warwick,
me the money.
I wouldn't say that. Warwick, first of all, obviously, I'm not going to make the comment on whether it's appropriate for you to start buying bond, but assume you have done your homework. Then I think in recent time, there are a lot of, start having some opportunity for individual investor to participate in bond directly.
Yeah. Right.
And obviously, I think both Mark and I are working for companies that offer that service, right? And you can do that directly directly buying bond yourself. In other words, you own a bond like you own a stock, or you can actually go through a fund, and obviously there are a number of those out there, and including ours, the Mason Stevens Credit Fund, and it all come down to whether what strategy you adopt depends on your own circumstance, which I'm obviously.
We're not going to have much time, but quite briefly, what is the Mason Stevens Credit Fund invest in? What do you buy?
We buy investment grade credit.
Yeah.
Typically between 3 and 5 years in duration.
Yeah.
Right, and with a target return of some after all the fee, about 3.5% above the cash rate.
Yeah.
And we normally try. This product is more an extension of what we have been offering our wholesale client for a number of years now.
Right.
And obviously to buy bond, one of the challenge buying bond, you got to buy in big parcel. This fund basically is to create that you don't have to buy a $500,000 bond.
Right. And you can go
buy
through.
Exactly
go
right.
through your planners.
Yes.
Okay. It's not a good time to buy bonds.
Well, look, lesson number one was diversify. So if you've only got equities and you're thinking of buying bonds, we would probably say that might not be a bad idea. Though we obviously don't know Warwick's individual circumstances. In terms of the time to buy bonds, we don't like global bonds. Australian bonds, we would say they've backed up a reasonable amount. So I'd agree that some opportunities may be appearing now. So if you've got an unbalanced portfolio, now might be a time to try and capture some of those better yields by dipping into the Australian bond market.
And to your point, I really like that idea that you're at the panic sell signals, which means that if you had money to invest, now's the time to, rather than when it's euphoric, because as you were saying, if it's euphoric, that's the time to start saying, hang on. Once everyone's at the punch bowl, you need to say, well, that's probably not a good thing to do.
I mean, I agree. I think one thing, David and I disagree on a number of things, but one thing I wholeheartedly with David
It's been a
tonight.
very pleasant show, actually. Normally you're much more verbose.
Tonight is, look, ultimately, I think, you should buy things when they are cheap.
Yeah.
Right? You shouldn't buy things when they're expensive. And
That's right.
As a result of that, I mean, look, if you are comfortable in buying a stock at $30, if it's now 20, maybe it's time to buy more, rather than just go to $40 and then you want to buy more.
Yeah, and then get it at the top.
Yep.
Look, that's all we have time for today. So thank you so much to my guests, Vincent Hua, the Chief Investment Officer for Mason Stevens, and David Stewart, who is the Chief Investment Strategist for Mercer Funds. And it's over to you, to all our viewers. Thank you for the emails and the phone calls. Until next time, I'm Mark Todd from FIIG Securities. Have a great weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.